Today we're going to look at the company Accenture, headquartered in Ireland and traded on the New York Stock Exchange under the ticker ACN. Please stay tuned for the important disclosure information at the conclusion of this video. Accenture's journey began not as an independent entity, but as the business and technology consulting arm of the accounting giant Arthur Andersen in the early 1950s. The division gained significant momentum in 1953 after installing the first computer system for commercial use at General Electric, effectively pioneering the field of IT consulting. As the consulting side grew more profitable and distinct from the auditing business, internal tensions led to a formal separation in 1989. At this point, the firm began operating under the name Andersen Consulting, legally distinct but still tied to the parent organization. The turning point came in 2000 following a landmark arbitration case that granted the consulting firm its full independence. Rebranding was a necessity, and on January 1, 2001, the company officially adopted the name Accenture, a portmanteau of accent on the future. Just months later, on July 19, 2001, the firm went public on the New York Stock Exchange. This IPO marked its transition into a global powerhouse. In the decades since, Accenture has shifted its headquarters to Ireland and evolved from a traditional systems integrator into a leader in digital, cloud, and security services. Major strategic pivots, such as the 2013 Cloud First initiative and a relentless string of acquisitions, have allowed it to stay ahead of technological shifts. Today, it stands as a Fortune Global 500 company, defining how modern enterprises navigate the intersection of business and technology. Accenture functions as a global leader in professional services, positioning itself as the primary reinvention partner for the world's most influential organizations. The company's business model revolved around a diversified revenue stream split primarily between high-value consulting fees and steady, recurring income from long-term outsourcing contracts. The company's customer base is exceptionally robust, serving approximately 9,000 clients globally, including more than three-quarters of the Fortune Global 500. These clients span a vast array of industries, from banking and healthcare to energy and consumer goods. Market reach is truly international, with operations in over 120 countries and 200 cities. Geographically, the business is managed through three primary markets. The Americas, which remains the largest revenue driver. The second is Europe, Middle East, and Africa. And third is Asia Pacific. By leveraging a massive global workforce of approximately 784,000 people as of early 2026, Accenture maintains the local presence and deep industry expertise required to solve complex, large-scale challenges across these diverse international territories. Accenture's trajectory over the past 20 years serves as a blueprint for how a legacy professional services firm can successfully navigate multiple waves of technological disruption. In the early 2000s, the company was still solidifying its identity following its separation from Arthur Andersen and its subsequent IPO. During this period, the revenue model was heavily weighted toward high-touch human consulting and traditional IT outsourcing, which provided a stable but linear growth path. As the global economy expanded, Accenture leveraged its deep industry expertise to become the primary partner for large-scale enterprise resource planning implementations, which essentially built the digital backbones of the world's largest corporations. The 2008 financial crisis presented a pivotal moment for the firm. While many competitors retrenched, Accenture focused on efficiency and global delivery, which allowed it to maintain a massive workforce while keeping costs competitive. By the early 2010s, the company began a deliberate shift toward the new, a strategic internal designation for digital, cloud, and security services. This was not merely a marketing pivot, it was backed by a massive acquisition strategy. Thousands of specialized firms were brought under the Accenture umbrella to bolster capabilities in areas like interactive marketing through Accenture Song and advanced analytics. This move transformed the company from a traditional back-office IT provider into a front-office growth partner. The arrival of the 2020s accelerated these trends exponentially. The global pandemic forced an immediate compressed transformation for nearly every industry, and Accenture was positioned as the architect of this shift. Revenue jumped from roughly $44 billion in 2020 to nearly $70 billion by 2025. This era was characterized by the move to the cloud and, more recently, the explosion of generative AI. By fiscal year 2025, the company had tripled its generative AI revenue to $2.7 billion, signaling yet another reinvention. Today, the firm operates with a balanced split between consulting and managed services, reflecting a business model that not only designs futuristic strategies, but also operates the complex digital cores it builds for its clients. Through consistent investment in research and development, Accenture has ensured that it remains at the center of the next technological frontier, moving from a service provider to an essential reinvention partner for the Fortune Global 500. Accenture's financial journey over the last 2 decades reflects its transformation from a traditional consulting firm into a global leader in technology services and digital transformation. The historical data presented in the table illustrates a business model that relies heavily on human capital and specialized expertise, with a primary cost driver is the compensation and training of its massive global workforce. By examining the progression from total revenue to operating cash flow, one can observe how the company maintains its high margins while scaling its operations across more than 120 countries. Total revenue serves as the primary indicator of Accenture's market reach, showing a remarkable increase from roughly $18.2 billion in 2006 to nearly $70 billion by 2025. This growth was not merely linear. It accelerated during periods of significant technological shifts, such as the move to cloud computing in the early 2010s and the recent surge in generative AI demand. In fiscal 2025 alone, the company added nearly $5 billion in incremental revenue, a testament to its ability to pivot toward high-growth areas. The cost of services remains the largest expense, consistently consuming a significant portion of revenue, as it encompasses the salaries and benefits of the consultants and engineers who deliver value to clients. The transition from revenue to operating cash flow involves several key operational adjustments. Sales and marketing expenses, along with general and administrative costs, provide the infrastructure necessary to support a global brand, but the company has demonstrated disciplined control over these areas to preserve profitability. Research and development spending has grown as Accenture develops proprietary assets and platforms to differentiate its service offerings. Taxes paid represent a significant cash outflow, reflecting the company's global footprint and the complexities of international tax regimes. A critical component of Accenture's cash flow management is the efficiency of its working capital. The table tracks the net difference between accounts payable and accounts receivable, which represents the company's ability to manage its short-term liquidity. By effectively timing payments to suppliers and ensuring timely collections from clients, Accenture often maintains a lean working capital profile. Furthermore, the contract liabilities row captures the cash collected up front for projects that have not yet reached the revenue recognition threshold. This is particularly prevalent in long-term outsourcing and transformation contracts, providing a steady stream of cash that bolsters the operating cash flow before the associated work is fully billed as revenue. The final segments of the analysis focus on capital allocation. Operating cash flow, which reached $11.5 billion in 2025, represents the total cash generated from the company's core business activities. Subtracting capital expenditures, primarily investments in property, equipment, and internal technology, yields the free cash flow. Accenture is known for its asset-light model, meaning its CapEx requirements are relatively modest compared to its massive revenue base. Finally, the inclusion of stock-based compensation is vital for understanding the true cash available to shareholders. While stock-based compensation is a non-cash expense on the income statement, it results in dilution if not offset by share repurchases. By subtracting stock-based compensation from free cash flow, we arrive at a more conservative metric of cash generation. Throughout the 20-year period, Accenture has consistently grown this figure, demonstrating that its expansion is not just a result of top-line growth, but also of superior operational efficiency and a disciplined approach to shareholder value creation. This financial stability has allowed the company to weather multiple economic cycles, including the 2008 financial crisis and the 2020 pandemic, while continuing to return significant capital to its investors. The evolution of Accenture's financial landscape over the past 20 years reveals a masterclass in disciplined capital allocation and the consistent conversion of earnings into tangible shareholder value. At the heart of this narrative is the company's ability to generate robust free cash flow, less subtracting stock-based compensation, which has grown from roughly $1.6 billion in 2006 to nearly $9 billion by 2025. This specific metric serves as the primary engine for Accenture's multi-decade growth and return story, illustrating a business model that scales efficiently without requiring excessive capital intensity. The most striking feature of Accenture's capital allocation is the relentless commitment to returning cash to shareholders. Since 2006, the dividend has transitioned from a modest annual payout into a substantial, growing quarterly commitment. What began as a $0.3 billion annual outlay has swelled to $3.7 billion in 2025, reflecting at least 20 years of dividend increases. This trajectory highlights management's confidence in the stability of their consulting and managed services revenue streams. Even more aggressive than the dividend program has been the firm's share repurchase strategy. By consistently buying back billions of dollars in stock annually, peaking at $4.6 billion in the most recent fiscal year, Accenture has effectively managed its share count, providing a steady tailwind to earnings per share and offsetting the dilutive effects of its employee compensation programs. Beyond returning cash, Accenture has utilized its financial muscle to execute a growth strategy, primarily through strategic acquisitions. While many firms struggle with integration, Accenture's approach is programmatic. The company typically spends between $1 and $3 billion annually to acquire boutique firms with specialized skills in cloud, security, and more recently, generative AI. A notable outlier in this trend occurred in 2024, when acquisition spending spiked to over $6.5 billion as the company moved aggressively to capture market share in a shifting technological landscape. These investments ensure that Accenture remains at the forefront of the investable basket of technology services, allowing it to take market share even during periods of broader economic uncertainty. The strength of the balance sheet provides the foundation for this dual-track strategy of aggressive returns and opportunistic growth. For much of the early part of this 20-year window, Accenture operated with virtually zero long-term debt, maintaining a pristine net cash position. In recent years, particularly starting around 2020 and expanding significantly in 2025, the company has utilized the debt markets more actively. This shift in capital structure, culminating in total debt of approximately $8 billion by early 2026, reflects a sophisticated approach to optimizing the weighted average cost of capital. Despite this increase in leverage, the company's cash and short-term investments have remained high, ensuring that the firm maintains a healthy liquidity cushion to weather market volatility. Ultimately, the data presented in this table paints a picture of a company that has successfully navigated 2 decades of technological disruption, from the rise of digital and mobile to the current AI revolution, while never wavering in its financial discipline. The synergy between high cash conversion, programmatic M&A, and a shareholder-friendly return policy has allowed Accenture to maintain its premium valuation in the marketplace. For investors and analysts, the story told by these numbers is one of durability and strategic foresight, as the company enters 2026 with a robust balance sheet and a clear mandate to continue its role as the primary architect of enterprise transformation. Accenture is currently led by Julie Sweet, who serves as the company's chief executive officer. Sweet is 59 years old as of early 2026 and has been a cornerstone of the organization for over a decade. She first joined Accenture in 2010 as general counsel before rising through the ranks to become the CEO in 2019. Under her guidance, the firm has navigated a significant pivot toward artificial intelligence and digital transformation. Her compensation reflects her leadership of this global giant. For the most recent reported fiscal year, her base salary was approximately $1.6 million. However, her total compensation reached roughly $29.6 million, with the vast majority of that figure tied to stock-based awards and performance bonuses designed to align her interests with those of the shareholders. The company's ownership structure is heavily dominated by large-scale institutional investors, who hold approximately 80% of the total shares. In contrast, individual company insiders, including suite and other executive officers, own a very small fraction of the total equity, estimated at close to 0%. The remaining balance, about 20%, is held by the general public. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. In the bull case scenario, generative and agentic AI act as a massive tailwind, fundamentally altering the consulting landscape. Accenture successfully captures this market, tripling its advanced AI revenue in a single year to $2.7 billion by 2025. The story here is one of total enterprise reinvention, where AI becomes the primary driver of all client services, allowing Accenture to command premium pricing and deeply embed itself in the operations of nearly every Fortune Global 500 company. This leads to high-growth revenue as clients move from experimental pilots to full-scale AI production. Profitability expands as the company leverages its own AI tools to deliver services more efficiently, offsetting wage inflation. The base case assumes Accenture continues its historical role as a reliable compounder. Growth is driven by the steady migration of enterprise systems to the cloud and a gradual integration of AI. While consulting demand may occasionally soften due to macroeconomic uncertainty, managed services provide a resilient, recurring revenue base. In this narrative, Accenture maintains its market share by out-executing competitors through its massive global scale and deep ecosystem partnerships with tech giants. Capital allocation remains shareholder-friendly, with consistent dividend hikes and aggressive share repurchases. The bear case centers on the risk that AI and automation commoditize the very services Accenture sells. In this scenario, lower-cost competitors or even open-source AI models disintermediate traditional consulting roles. Client spending remains cautious due to persistent geopolitical tensions and public sector cuts, leading to stagnant growth. The company faces margin pressure from intense price competition and the high cost of retaining elite talent in a tightening market. Acquisition-led growth becomes more expensive and less effective, leading to a long-term slowdown in value creation. In the bull case scenario, we assume the following: revenue growth at 9.5%, operating cash flow margin at 17%, CapEx growth at 8%, stock-based comp growth at 10%, dividends growth at 10.5%, stock repurchase at 8%, acquisition spending in the next 20 years at $100 billion. Stock repurchases assumes price-to-sales ratio of 2.3. With this discounted at 7.5%, dividend model yields $218 worth of value per share in 20 years, $440 in 30 years, and $792 in 40 years. In the base case scenario, we assume the following: revenue growth at 6.5%, operating cash flow margin at 14%, CapEx growth at 5%, stock-based comp growth at 7%, dividends growth at 6%, stock repurchase growth at 4%, acquisition spending in the next 20 years at $70 billion. Stock repurchases assumes price-to-sales ratio of 2.3. With this discounted at 7.5%, dividend model yields $132 worth of value per share in 20 years, $204 in 30 years, and $274 in 40 years. In the bear case scenario, we assume the following: revenue stalls with 3% growth, operating cash flow margin at 12%, CapEx growth at 2%, stock-based comp growth at 4%, dividends growth at 2%, Stock repurchase growth at 1%. Acquisition spending in the next 20 years at $30 billion. Stock repurchases assumes price-to-sales ratio of 2.3. With this discounted at 7.5%, dividend model yields $79 worth of value per share in 20 years, $99 in 30 years, and $112 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.